Imagine you're sitting across from a life insurance agent. Friendly, professional, and knowledgeable. At some point in the conversation, they slide a comparison across the table. On one side is term life, and on the other side is whole life insurance. They explain that term is like renting an apartment, where you pay every month and walk away with nothing. Whole life, they say, is like buying a home, because you're building something and investing in your future. That framing is compelling, and it's also incomplete. The part that gets left out of that conversation is where a significant amount of money either stays in your pocket or quietly disappears over the next 20 years. This video is about the real math behind term life versus whole life insurance, not the marketing version. The version where we look at what each policy actually costs, what it delivers, and what happens to the gap between them. Let's start with the basics, because both of these products exist for a legitimate reason. Life insurance solves one core problem, which is that if you die while other people depend on your income, they should not be financially destroyed. Everything else, the cash value, the investment component, the wealth-building language, comes after that fundamental purpose. Term life insurance solves that problem for a specific window of time, whether 10 years, 20 years, or 30 years. If you die during that window, your beneficiaries receive a death benefit. And if you outlive the term, the coverage ends. The premiums are fixed during the term, and they're relatively low because most people who buy a 20-year term policy will outlive it. Whole life insurance solves the same core problem, but permanently, as long as you keep paying premiums. The premiums are fixed, they never go up, and part of each payment goes toward what's called cash value. Cash value is a savings component inside the policy that grows at a guaranteed rate, and you can borrow against it or surrender the policy for it. Both of those things are real, and the question isn't which product is honest and which is a scam. The question is which product matches what you actually need for people at most income levels and in most life situations. To answer that, we need to look at what each one actually costs. So let's build a real scenario. This is not a hypothetical designed to make one product look bad, but a reasonable illustrative scenario using market rate data from 2026. Take a healthy, non-smoking adult, a 40-year-old man, who wants $500,000 of life insurance coverage. He has a mortgage, he has kids still in school, and he has a spouse whose income alone wouldn't cover everything if he were gone. If he buys a 20-year term policy, market data from major carriers suggests his monthly premium would be in the neighborhood of $50 to $60. Let's use $59 a month, which is a figure drawn from current multi-carrier market averages for that profile. For that $59 a month, he has $500,000 of coverage for 20 years. When his youngest kid finishes college and the mortgage is mostly paid down, that coverage ends. But so has much of the financial exposure. Now look at the same man buying whole life insurance for the same $500,000 death benefit. According to current market data from the same carrier pool, his monthly premium would be in the range of $500 to $600 or more. Let's work with a figure toward the lower end of that range and call it $574 a month. Sit with that difference for a moment, because both policies pay out $500,000 if he dies. One costs $59 a month, and the other costs $574 a month. That's a gap of roughly $515 every single month, which adds up to about $6,000 every year. Over 20 years, assuming he keeps both policies active, the premium difference alone is somewhere around $120,000 out of pocket. The whole life agent will tell you that's not a fair comparison, because the whole life policy is building cash value. And that's true. We'll come back to what that actually means. But first, let's understand why that premium is so much higher. With term insurance, the insurance company is betting that you'll probably outlive your policy, and most people do. With whole life, they're guaranteeing a payout eventually, to someone, no matter what, which is a fundamentally different product, and the price reflects it. Neither of those things is dishonest, but they do mean you're paying for things you may or may not need. Here's where the conversation shifts, because that $515 monthly difference isn't just an abstraction. It's a decision point every single month for 20 years, and the question is, what happens to it? In the whole life scenario, it goes toward the policy, where part covers the insurance cost and part goes into cash value. Whole life cash value is real, it's accessible, and it's not a fiction invented by salespeople. So for some people, the forced savings mechanism is genuinely useful. But here's the scenario worth walking through carefully, and it involves what happens if you take that $515 monthly difference and invest it. Before I say the next sentence, let me be clear that I am not telling you what your investments will return, because nobody can promise you a market return. What I'm going to do is show you what a reasonable historical assumption produces, clearly labeled as a modeled scenario and not a guarantee. If you invested $515 a month into a broad index fund, and if that fund returned roughly 7% annually on average, here's what happens. 7% is a conservative, historically grounded assumption, often cited over long time horizons, though past performance does not guarantee future results. After 10 years, that account would be in the neighborhood of $85,000 to $90,000. After 20 years, the account would be approaching $250,000 to $270,000. That is not the death benefit, because the term policy takes care of the death benefit while you're doing the investing. The investment account is wealth you're building on top of the coverage, separately, with full flexibility over how it's invested and accessed. This framework is commonly described as buy term and invest the difference, and it isn't a fringe idea invented by bloggers. It's a recognized approach in fee-only financial planning circles because it separates two things the whole life policy bundles together. Those two things are insurance protection and savings accumulation, and when they're separated, you can optimize each one independently. When they're bundled together, you're accepting someone else's judgment about the right balance between them. Now here's the genuine surprise that most people don't focus on when they look at how cash value actually works in the early years. In the first several years of a whole life policy, cash value grows very slowly, because a large portion of the premium goes toward the cost of insurance and the insurer's expenses. Agent commissions can represent a significant portion of the first year's premium, so if you surrendered a whole life policy in year 2 or 3, you'd likely get back substantially less than you paid in. The cash value takes time to accumulate to a meaningful level, while the term buyer who started investing the difference has money in an account from month 1. It's small at first, but it's growing, and it belongs to them outright, with no surrender timeline attached to it. Let's trace the 20-year arc more carefully, starting with the first 5 years of each approach. In the first 5 years, the term buyer has paid roughly $3,500 in premiums and built a growing investment account with a separate pool of capital. The whole life buyer has paid roughly $34,000 in premiums and has some cash value, which is meaningful, but likely still below what they've put in. By year 10, the term buyer has paid about $7,000 in total premiums, and under our modeled scenario, has somewhere in the $80,000 to $90,000 range invested. The whole life buyer has paid roughly $69,000 in premiums and has accumulated more substantial cash value, but still typically less than the invested premium difference would have produced. By year 20, the term coverage expires, and at that point, the mortgage is largely paid off and the kids are adults. The financial exposure that made a $500,000 death benefit feel urgent has significantly declined by that stage. In the investment scenario, there's a pool of capital in the range of $250,000 or more under our modeled assumptions. That capital is liquid, it's not locked in a policy, and it doesn't require a loan application to access any of it.
It's also worth noting that it doesn't have to wait for you to die to be useful, which is a meaningful distinction.
The whole life buyer at year 20 has also accumulated cash value and still has lifetime coverage, which is genuinely valuable. What they haven't necessarily done is outperformed the alternative, and that's the part that gets quietly omitted from the sales conversation. Now, this all assumes one critical thing, and that is that the term buyer has to actually invest the difference every single month. Not spend it, not let it sit idle in a checking account, but invest it consistently, the way a whole life premium payment is automatic and forced. This is a real behavioral variable, and whole life's premium structure enforces savings discipline in a way that a voluntary brokerage contribution simply does not. For some people, that discipline has genuine value, and that is not a trivial point. So let me be straightforward about the cases where whole life genuinely makes sense. The first real use case is permanent coverage for a lifelong financial dependent, such as a child or family member with a serious disability who will always need support. A 20-year term policy doesn't solve that problem, but whole life does, and that's a legitimate and well-documented reason to choose permanent coverage. The second use case is high net worth estate planning, where an estate is large enough to face federal estate taxes, which in 2025 applied above roughly $14 million. Life insurance death benefits can be structured to cover those taxes without forcing heirs to liquidate assets, and for that purpose, permanent coverage is often the appropriate vehicle. This is a specific, well-documented use case, though it's not the situation most people are in when buying insurance in their 30s or 40s. The third case is business succession planning, where a business owner uses permanent life insurance to fund a buy-sell agreement for a deceased partner's share. Again, this is a real use case for specific circumstances, and not the situation of the typical family buyer shopping for income replacement coverage. The fourth case is the person who genuinely cannot or will not invest money independently, because if someone's history suggests they'll spend the premium difference, whole life's forced savings has real value. The policy acts as a savings mechanism with the death benefit attached, and for someone who doesn't have a brokerage account and never will, that comparison with investing is simply irrelevant. There's also one more honest point worth making, which is that a term policy expires, sometimes before you expect to need coverage again. If your health deteriorates significantly in your 40s or 50s, getting new coverage when your term ends can become difficult or very expensive to obtain. Whole life, once issued, cannot be canceled by the insurer due to health changes, and that guaranteed insurability has real value for the right buyer. You just have to decide whether it's worth the sustained premium difference to lock that guaranteed insurability in from day one. Here's the one idea I want you to take out of this video, because it applies to every version of this decision. Life insurance is a product category designed to solve a specific problem, and term solves it for a defined window of time, cheaply and cleanly. Whole life solves it permanently, with savings bundled in at a substantially higher cost, and neither of those approaches is inherently wrong. What is incomplete is when the decision gets made without seeing the premium gap, and without understanding what that gap could become if invested separately. The research on this is consistent, as most working Americans overestimate what life insurance costs and underestimate how much coverage they actually need. Many make the decision based on a single conversation with someone who has a financial incentive tied to one type of policy over another. That doesn't make agents villains. It makes this a situation where information matters, and where two products that look similar have fundamentally different cost structures. So the next time you're in that conversation, or reviewing a policy you already have, ask one question, which is, what happens to the premium difference? If the answer is that it builds cash value, ask what that cash value looks like in year 5, year 10, and year 20, in guaranteed figures, not projected ones.
Then ask yourself whether that growth, compared to what you could do with that money elsewhere, actually matches your goals and your timeline.
That's the comparison the brochure rarely shows you. And now you've seen it. If this kind of breakdown is useful to you, consider subscribing, because the next topic in this series looks at whether paying off your mortgage early or investing the difference comes out ahead.
Same structure, same math, and the same honest look at both sides. And you might be surprised which one wins and when.